Okay, Dennis, you're on.
Okay, thanks for all the. I mean, without Robert, we wouldn't have it. Just be black and white slides. It's incredible. Okay, so welcome to the Kushner Report for January of 2025. And at the conclusion of today's presentation, you'll have an opportunity to participate in our question and answer session. So today we're going to take a look at key economic indicators, the global economy, the domestic economy, mergers and acquisitions, other significant economic news. And today we're going to take a look at the 2025 economic outlook and underlying assumptions. And I'm going to cover some things on the on different topics along these lines. So the first thing I'd like to take a look at right now is the U.S. economy going forward. So as you know, the economy in 2025 really involves a blend of historical data, current trends, and expert forecasts. While no prediction is really certain, economists typically base their outlooks on certain key assumptions, which are subject to change based on geographical, political, environmental, and market developments throughout the year. And as you know, this is the first year of the new administration, so a lot of things will unfold as the year begins to evolve. So, taking a look at the economic, for first of all for the year, we're expecting to see growth at a moderate rate this year, somewhere between 1.5 and 2.5%. And we need to see more productivity gains, technology innovation, and stable consumption. So there are influencing factors that will take place, and that is growth will depend on continued consumer spending, business investment, the labor force participation, and the resolution of a lot of the global trade tensions that we're seeing right now globally. The labor market, we're looking at somewhere between a low inflation unemployment rate of 3.5 to 4.5% this year. The labor markets are still likely to tighten with potential skill mismatches between available workers and employee needs. The labor force participation rate may continue to be relatively stable as more people return to the workforce subsequent to the pandemic. And the participation rate will continue to remain very strong as well. The job market trends are there's significant shifts taking place in skill sets, and that is continuing emphasis is on technology driven roles and energy. So you forget if you look at areas such as AI, data science, cybersecurity, those are critical in the area of technology. And then you have healthcare and of course green energy. On the other hand, some of the traditional roles, particularly in manufacturing and routine services, may experience lower growth. However, we do face challenges. You've got a skills gap, and that is as the demand for technology driven requirements grows, many employers will struggle to fill positions requiring advanced technical skills. So, workforce development and training programs will be key to bridging the gap of these skills. A good example is the semiconductor industry right now, where we're bringing in a lot of people from outside the country that have the skills because we don't have all the skills that we need here to hire people locally. There are challenges, though, we face, and that is we have an aging population, and the retirement of the baby boomers will continue to put pressure on the labor force, particularly in healthcare and other critical sectors. We're looking at inflation. Inflation is expected to stabilize around 2 to 3% near the target market of the Federal Reserve, though it may fluctuate based upon supply chain disruptions, energy prices, and wage pressures going forward. Core inflation, basically, if you exclude volatile food, energy prices, and will remain more stable going forward during the year. When we look at the public debt structure, the U.S. national debt is expected to continue to rise, potentially exceeding $35 trillion this year. And there may be ongoing debates about how to manage the fiscal deficit as well as debt sustainability. The real focus will be on spending on focusing on infrastructure, defense, and social programs. From a technological perspective and productivity, we're looking again at artificial intelligence, automation, and green technologies, and biotech will focus on productivity gains throughout the year. And again, we talk about the remote and digitalization. Well, the rise of remote and hybrid workforce arrangements is expected to continue throughout most of the year. Although many companies are telling employees they want them back in the office 5 days a week. And that transformation will continue throughout the year. The U.S. will likely continue its shift toward renewable energy sources with increasing investments in solar, wind, electric, and vehicle infrastructure. And we can see here that oil and gas prices will fluctuate based on geopolitical events that will take place. As you know, we're going to be opening up and bringing more oil to the marketplace. The housing industry, which is going to be very interesting. The housing industry may continue to be tight, with home prices appreciating at a slower pace. Interest rates and supply chain issues will impact housing affordability. The one thing to look at, if you look at commercial real estate, could face long-term shifts due to remote work trends, potentially increasing the demand for mixed-use developments or shifting priorities to logistics centers. The real estate experts in real estate are projecting that the commercial real estate market will not come back to full force until probably 2030, if not longer than that time frame. When we look at demographics, again, as I mentioned earlier, we have an aging population, and the U.S. will continue to experience this going forward as baby boomers continue to retire in numbers. This is going to put a lot of pressure on the healthcare systems, pensions, and workforce dynamics. The other concern we have is immigration, and that is policies and flows could significantly impact the labor force, especially with birth rates remaining below replacement levels within the United States. When we look at the financial markets, U.S. stock markets may experience volatility in the short term, but are likely to see modest returns in the near term. The real concern is we'll focus on more likely with companies on driven by growth. So stock values are really going to be tied to growth going forward in 2025. And there are investment shifts, as we said earlier, and that is environmental, social, and governance investing as companies face pressures from regulators and have to adopt sustainable practices and policies. When we look at consumer spending, we look at moderate growth. Consumer spending is really expected to grow somewhere between 1.5 and 2.5% this year. And again, when we look at inflation, as I mentioned earlier, the impact there is somewhere between 2 and 3%. But like I said, we'll see where that goes. There's also going to be a shift in consumers' behavior. That is, the trends toward e-commerce and spending will continue. In other words, travel, dining, and entertainment are really expected to continue and grow this year. And of course, you have technological integration, and that is integration of fintech and digital payment systems will continue to spur on consumer spending and make it more seamless. So this is good news on that part. Manufacturing, which is a really bellwether for the United States, we're going to see more reshoring and onshoring. And the trend will be to bring back manufacturing to the United States in all vertical markets. And this will likely continue throughout 2025. This is driven by supply chain disruptions, national security concerns, and geopolitical risks. Example, tensions with China. So the key sectors such as semiconductors, pharmaceuticals, and green technologies are expected to see significant increase in production. And again, with automation, robotics, and artificial intelligence, all are expected to play a larger role in the United States manufacturing, driving productivity improvements throughout and reducing dependence on low-wage labor. We're seeing that happening throughout the country as we speak. When we look at the supply chain, after the disruptions of the pandemic, companies are really focusing now on building more resilient supply chains. We're looking at nearshoring and diversification. So the trends will be to move manufacturing closer to the United States. And that's expected to continue with more manufacturing and assembly plants being located in neighboring countries such as Mexico and Canada. And again, we'll see this in the long term. Digitalization is happening. We're seeing the digital transformation of supply chains will accelerate, leveraging blockchain for transparency. So that kind of gives you a snapshot of what's taking place in the U.S. economy. Now, one thing that a lot of people have talked about is about the dollar. What's taking place with the U.S. dollar? Well, if you look at it, it depends on a variety of factors. For example, it includes the U.S. economic performance, global geopolitical conditions, interest rates, and inflation trends. Now, here's some of the things to take into account that are key factors. U.S. growth. So the growth in the United States is expected to continue and experience solid growth throughout the year. The GDP and consumer spending, robust labor market, consumer spending, and continued recovery in sectors like manufacturing and technology will help sustain the demand for the US dollar. When we look at debt levels, if fiscal policies lead to higher interest rates, debt levels, it could raise concerns about whether the dollar's long-term stability and value will continue going forward in the right direction. Interest rates, the Federal Reserve's monetary policy will also play a key critical role. If the Fed continues to raise rates or maintain high interest rates to curb inflation, this could make the dollar more of an attractive foreign investors, boosting demand. When we talked about inflation, with inflationary pressures, there's still a concern in some regions that the Federal Reserve has to manage inflation effectively, which could help strengthen the US dollar. Globally, a strong dollar will often lead to greater demand for the US dollar as a safe haven for investors, and that's taken place all along. A lot of investment money is here in the United States. And again, events like trade wars, military tensions, or political instability in major economies such as China, European Common Market, could lead investors to flock to the US in strength as a safe haven for their funding. Inflationary pressures, persistent inflation could erode the dollar's value, particularly if wage growth outpaces productivity. The US dollar is also often very sensitive, inversely correlated with common commodity prices, especially oil. And we've seen that. I'll talk more about that in the presentation. The role of the dollar, well, the US dollar remains the dominant global reserve currency as a status that provides consistent demand throughout the world. We are seeing a change where there's a rise in the central bank in terms of digital currencies, and the increasing interest in cryptocurrencies could potentially challenge the dollar's dominance in the future. Again, the US trade continues to run large deficits and importing more than we export. That's got to change. If we look at the emerging demand marketplace, many emerging markets still rely heavily on the US dollar for trade and debt issuance. And a strong dollar is beneficial for these countries in terms of lowering borrowing costs and also having access to capital with stable capital flows. Now, there are three key scenarios regarding the dollar. Scenario number one says we have a strong dollar, and that is if the US economy remains resilient, inflation is controlled, and the Fed maintains restrictive monetary policy to keep rates elevated, the dollar could strengthen relative to other currencies. Scenario number two says a weaker dollar. If inflation proves difficult to control, the federal government will cut interest rates to stimulate growth. And finally, stability, and scenario number three, and that is in a scenario where economic growth is steady, inflation is managed effectively, and the Federal Reserve takes a neutral stance on interest rates, the dollar could maintain relative viability. And I think that's kind of where we're trying to go, is scenario number three. So in 2025, the outlook for the US dollar will largely hinge on the US, how they manage inflation, interest rates, and its economic growth trajectory. So while the dollar is likely to remain a dominant global currency, its strength will really be influenced by the domestic policies and broader geopolitical and economic trends. So that kind of takes you where the dollar is. A lot to think about. Now, last year, the term recession kept going on from January through December. And there was a lot of concerns. Are we going to have one? Are we in one? Where are we going to be? The likelihood of a recession in 2025 is influenced by a lot of complex factors, economic factors, including government policy, global conditions, and of course, domestic trends. As of late 2024 and last week, most economists believe that there is a 45% probability of a recession by the end of 2025, which means 55% will not have a recession. So I think that's good news from that standpoint. The Federal Reserve has been adjusting interest rates to combat inflation, but if inflation remains persistent, it may keep rates higher for a longer period of time. That's a concern they had when the Federal Reserve met yesterday. Inflation is a major concern for the U.S. economy, and while inflation has been moderating in 2024, the potential for future price pressures remains still strong. Rising inflation, again, hurts confidence, both in the government and the consumer. Global economic conditions, including geopolitical risks, supply chain disruptions, and growth in major countries such as China and the EU will play a major role going forward. As of the end of 2024, the U.S. labor market has been relatively strong with very low unemployment rates. However, labor market conditions can change, particularly if companies start laying off workers in a response to tighter financial conditions or weaker demand for products and services. Corporate profits are really a good barometer of economic growth. You can see that with some of the companies in the stock market that have had tremendous growth in 2024. And again, the decline basically in business confidence can also lead to more cautious investment, which could trigger a downturn. When we look at the debt and fiscal policy, U.S. debt levels have been rising. And while this is not an immediate trigger for a recession, it could pose risks in the medium term. So in concluding, while it's difficult to get precise probability, the risk of a recession in 2025 is moderate. It's influenced by factors, as I mentioned, inflation, interest rates, global conditions, and potential shocks to the economy. So let's take a look at the global outlook, what we see happening. There are a lot of tensions and global stability issues facing the United States and other countries around the world. The relationship between the world's two largest economies, China and the United States, will continue to be a major factor in global economic landscape. We look at the ongoing war in Ukraine remains a significant source of uncertainty. Now, when we look at some other patterns and regional differences, the Eurozone, basically, growth in the Eurozone is expected to be modest, as many countries still grapple with high inflation. Japan, their economy will face challenges from its aging population and deflationary pressures, despite efforts to stimulate growth through technological innovation and fiscal policy. And there are other key markets. So China, for example, after facing slowdowns in growth due primarily to the zero COVID policies and structural changes and challenges, China's economy will likely face moderate growth in 2025. We look at India. India is expected to be one of the world's fastest growing economies, benefiting from strong demographic trends, rising middle class, and rapidly growing technology and service sector. So they're really moving far and fast compared to the other countries around the world. If we look at Africa and Latin America, economies could experience moderate growth driven by rising commodity prices, increased infrastructure investment, and again, improving governance. We look at this in the areas such as chocolate, coffee, all types of products, commodity products around the world. The price continues to rise. If we look at inflation and interest rates, well, while global inflation is expected to moderate from the 2022 and 2023 time levels and highs, it's unlikely to return to pre-pandemic levels. High food and energy prices, supply chain disruptions, and labor market pressures will keep inflation elevated, especially in developing regions. And of course, central banks around the world, like the European Central Bank and the Bank of England, etc., will likely continue to maintain high interest rates for the time being. When we look at technology, innovation and disruption, so technological advancements, particularly in artificial intelligence, robotics, and automation, will reshape industries and job markets worldwide. The green energy transition continues moving forward, the push more towards more green energy around the world. And then we have the growth of digital payments. Cryptocurrencies and blockchain technologies will continue to transform global financial system over the next several years. When we look at climate and sustainability, we're looking at extreme weather conditions. So, for example, climate change related disruptions such as extreme weather events, hurricanes and floods, droughts, etc., will likely continue to affect agricultural production, infrastructure, and global supply chains around the world. We look at the green transition costs. While the global push for sustainability is gaining more momentum, the transition to greener costs will come at a very high, significant cost. From a global trade perspective, the pandemic, trade tensions, global and geographical risks have really forced companies to reassess global supply chain. So this year, look to see continued reshoring and diversification of supply chains as global companies seek to mitigate risk. And of course, if you look at global trade, many experience modest growth with supply chain disruptions and trade barriers impacting the flow of goods and services. So what are some of the key risks? So first of all, we're looking at a global recession, and that is a potential global recession or a slowdown in key economics areas could dampen growth. It could increase unemployment and put pressure on markets. We also see rising debt levels, and that is particularly in developing countries, could lead to sovereign defaults or debt restructuring, potentially targeting financial instability in the global economy. Prolonged inflation and rising costs, living costs, and our key economic indicators could undermine a lot of the consumer confidence and spending, particularly in developing nations. You know, you have rapid development and enhancements, if you will, in AI, automation, and robotics could also lead to a lot of job displacements, creating social and economical challenges in many of the regions of the world. And then, of course, we have climate change, and that is unchecked climate change could lead to catastrophic economic loss, particularly in vulnerable areas through natural disasters. Agricultural disruptions are really a key concern, and of course, you have rising sea levels. So that kind of takes you through what's going on a global perspective. And again, keep in mind, as we move into February and March and April, you're going to see a lot more change, a lot more information we'll be able to talk about going forward. So now what I'd like to do is take a look at the domestic economy, and we're going to take a look at key economic indicators. So we're going to look at gross domestic product, inflation, unemployment at both the federal and the California level, and then the price per barrel of oil. So these numbers won't be finalized probably until March. And that is, global economy went out, the GDP went out around 2.9% the end of 2024, and the expectations are it should drop down to 2.5% in 2025 as a lot of uncertainty is moving forward. When we look at the GDP in the United States, we looked at 2.3% going out the end of this year and dropping down to 2% next year as concerns about the slowing economy. Inflation going up probably around 3.1% and hopefully dropping to 3% next year. The unemployment rate nationally was at 4.1% going out the end of the year and then possibly dropping down to 4% next year. So it's still going to be relatively a tight market going forward. When you look at the California,
pain medication and
Harvey, turn off put yourself on mute.
It's necessary.
So if you look at unemployment in California, it went out at 5.5% last night. And unfortunately, the California economy is struggling further behind the rest of the country. So we're looking at going out about 3.9% next year. Now, the price range on oil is around $75 to $85 a barrel, and that's been vacillating. And I'm going to talk more about that as we move into the oil area of the presentation. So the Bank of Japan, when we look at the global perspective, the Bank of Japan is holding policy rates relatively stable at this point to encourage uncollateralized overnight rates to stay pretty well flat. Concerned about their economy. You look at the Bank of England, they delivered another rate cut, down 25 basis points. It's at 4.75% in December. The Bank of Canada dropped it basis points by 50. And then we look at the central banks, European Central Bank lowered rates as well. And they dropped it by 25 basis points. And of course, the Swiss bank dropped theirs by 50 basis points. So the message here is that interest rates are dropping as inflation begins to subside, but it's still higher than expected to be by the time we get to the end of the year. Now we look at domestics. In December, the Federal Reserve dropped the discount rate by 25 basis points. And as you know, they had a meeting yesterday, and based upon the concerns about inflation, they're going to hold the rates in check for the time being, and they'll be examined as we move further into the year. The biggest concern we have right now, the end of the third quarter, we had $1.17 trillion in credit card debt. and that's the highest on record since 2003. Much concern about credit card debt going forward. Business bankruptcies, unfortunately, were substantial last year. There was a 14-year high in bankruptcies. And as we talked about earlier, there were over 55,000 restaurants that closed in 2024. The wholesale market, if you will, if you look at inflation again, inflation in December was up to 2.9%. It rose a little bit more. Concerns about unexpected strength in inflation for the latter part of December. Now we take a look at the wholesale index. The index went up a little bit too, is up 0.2 of a point, undercutting expectations. So hopefully that has to improve further going forward. The trade exports had a good month. We were up to $274 billion in trade exports. That's up about $7 billion over the October figure, which is very good. The U.S. trade deficit, for good news, it fell by 2% to $63 billion. If you go back several months ago, we were even around between 80 and 90 billion dollars, which in one point was over $1 trillion on a run rate. The good news is we're seeing that shrink. But again, if you annualize 63 billion over the year, you're still talking about $700 billion in deficit. That's got to be reduced substantially. And I think they're talking about that with potential tariffs discussions going forward. Retail sales stemming back from the holiday seasons of Thanksgiving and Christmas were very strong. And with the exception of automobiles and gasoline, retail sales were up 1.7% in December, which is a very good, strong month. Now let's take a look at the job market. So on a national basis, we saw the creation of 256,000 jobs in December, and the unemployment rate nationally remained at 4.1%. The key sectors to look at here was business and professional services was up, health and education. The real barometer to look at here is the negative in manufacturing. They lost 13,000 more jobs. Again, continue to staying in contraction. That's got to change going forward. Now, I got this slide last night at 6 o'clock, and Robert was great to put it in. If you look, payrolls in California increased by 15,000 in December. Unemployment roll, however, rose to 5.5%. The only key things to look at here was in the IT area information, saw some gains, leisure and hospitality, and in California, manufacturing saw job losses. Now, if we look at interest rates, as I mentioned earlier, the Federal Reserve decided to keep interest rates flat going forward for the next few months. So at this point, it's staying in a range. We dropped the 25 basis points in December, and that'll stay where it is for the time being. Mortgage rates, the good news is here on mortgage rates, we saw that change, which is the good news is it was well over 7%, Lana, a few weeks ago. It's dropped down now to 6.84. But the target number the economists are looking at is somewhere around 6.25 to 6.50 for the entire year. That's what it's pegged at right now going forward. And again, as I mentioned earlier, the manufacturing index, 56 months in a row, going back to April of 2020, we're in a contraction mode. Dropped down again. It's still below the 50 basis points. It's got to go over 50 to be able to show that it's turning around and we're seeing a positive movement in manufacturing. Area factory orders were down 0.4 of a point in November. Things had slowed down substantially. Now we look at small business confidence level. It was the highest level in more than 6 years, which is very good news. It was up 3.4 points, which is well over 105. But again, anything over 100 is very strong. So it's very good for small business confidence level. Consumer confidence, on the other hand, dropped 8 basis points down to about 105. But again, it's still over the 100 points, so it's still in positive form at this point. When we look at the price of crude oil this morning was just at $73 a barrel, and it was at $71 a barrel in December. Now, between our last meeting in December, we saw that oil was up even as high as $77, $78 a barrel. So it's starting to regress down again. Hopefully it'll stay at this level, if not go lower. We take a look at the housing market. Well, Total gains boosted. We had a sizable gain of housing starts in the month of December. They were up 15.8%, a staggering number. This is very good news going forward in the housing market. Now, new home sales, unfortunately, fell by 4.5% in the month of December. And again, a lot of this has to do with mortgage rates and being able to qualify for mortgages. So let's take a look at Southern California. In Los Angeles County, the median home price was at 912,000, and that decreased by 2.6% from November. But sales were up by 12.7% from November of last year, and they were up 16% from December of 2023. So they had a pretty strong month. Orange County, the median house price at 1,362,000 decreased by 0.9 of a point, very slight. Sales were up by 1.8% over November, and sales were up almost 21% over December of 2023. Now, when we look in San Diego County, the median price of those on the market was 975,000, remained the same in December as it was in November. Sales were up by 1.5% over November, and they were up 27% over December of 2023. So that was very good month for that particular area for San Diego. Now, if we take a look at construction spending, basically, it was relatively flat again for the month. A lot of this had to do with weather across the country. So we should see that start picking up as we move into January and February. Productivity information for the fourth quarter will probably not be available till either late February or mid-March because of tracking. And then, of course, we talk about company disbursements, and these are numbers that are significant. So first of all, we saw positions eliminated in Visa, 1,400, Nissan globally, 9,000, Meta, which is Facebook early in December, was 900. We have AMD, 1,000, Pitney Bowes, 2,300, Amazon, 14,000. And then we saw a couple places like Ross Stores, 1,600, and then Facebook, Meta, if you will, about a week ago, 3,600. So the good news is there's a lot fewer companies laying off substantially across the country. Mergers and acquisitions was a banner year last year for 2024. A lot of activity in a lot of different vertical markets across the board. And we started off with a bang in December and January. So first of all, an investment firm called Nexus Capital Management is buying Big Lots, and they're going to keep the operations open. They're going to close some stores, but they're going to keep moving forward. Then we have a company called Centura is acquiring retina consultants for $5.1 billion. This is in the retina practices that provides exceptional care across the nation in that particular area of the market. So that's going to increase their market share. Then you have BCE of Canada is buying Ziply Fiber. And what this is that they're buying apparently 1.3 fiber locations to gain a bigger footprint in the United States. Siemens is acquiring Altair for $10.6 billion. This is the global leader in computational intelligence. Then we have Cardinal Healthcare is active again. They're buying GI Alliance and ADSG for $3.4 billion roughly. And this investment will be to targeting expansion in high growth healthcare segments across the marketplace. And then we have General Mills, which is very interesting. They're buying a company called Whitebridge Pet Brands. And that's for $1.4 billion that they expand their market into other vertical sections with General Mills. And of course, we have this thing on Wheaties here. But if you look at BlackRock, BlackRock is expanding its private credit markets, buying HP Investments Partners. Investment Partners is the leader in global credit management. So this is a major move for BlackRock. Xerox is acquiring a company called Lexmark. Here we're acquiring Lexmark International. And what it does now, it's going to strengthen the core business in the print side and portfolio and build a broader global marketplace for print services by Xerox. And then Getty Images is buying Shutterstock to create a visual content company. As competition is fierce in this particular marketplace, especially with the generation now of artificial intelligence. Then we have Clearwater Analytics is acquiring Infusion. Infusion is a leader in software as a service, in other words, SaaS, and solutions for investment management and the hedge fund industry. J&J is buying a company called psychiatric drugs maker Intracellular, and what this is doing is for treatment in the area of mental health disorders and neurological conditions in patients. So they're expanding their business in that arena. Good news for J.C. Penney's. J.C. Penney's is merging with a company called Spark Group. It'll create a $90 billion entity for a clothing market. This will include Brooks Brothers, Eddie Bauer, Lucky Brand, Nakadia, and also Liz Claiborne. So this is a major move on the part of J.C. Penney's to keep them in business going forward. So that's really great news. And eBay is acquiring a company called Carmel Auto Sales Platform. And what it does is it's continuing to increase its commitment to its automotive marketplace. And you're seeing acquiring it. It's an end-to-end solution, online solution and platform. So eBay is getting more involved in the automobile industry online. So there's been a lot of activity taking place in other areas of the economy. First of all, we look at Tupperware, which has been around for God knows how long. And like I said, they went into bankruptcy, and they're now going to be bought by a lender. Stonewall Capital Management is buying them along with Aladdin Global, and they'll keep them moving forward. The company was originally founded in 1946. Good news for travelers. Airlines, by law, effectively late last year, airlines will now have to pay cash refunds for delayed or canceled flights, according to the Department of Transportation. So this is good news. So the days of just sitting in a runway for hours and so forth are over, where you can become compensated going forward. Wednesday's announced the closing of 140 restaurants. These were restaurants that they felt were not making profitability to what they wanted to do. So those are being closed. At the same time, they're opening up other restaurants in other areas where they think they can make a profit. $42 million buyout program for Palos Verdes homeowners. I think Ed can talk about that maybe when we get to Q&A. But that's, at least there's something going on there. You know about all the issues that are taking place in Rolling Hills Estates and also in Palos Verdes. TGI Fridays, who's been around for a long time, the operator of 39 domestic restaurants, has filed Chapter 11 bankruptcy protection. Then GM announced that it's basically the production of its Cadillac XT4 SUV is shifting to electric vehicles, and at the end of January, those vehicles will no longer be made. And Spirit Airlines, as you know, has been in talk of mergers and acquisitions over the past year and a half, has filed Chapter 11 bankruptcy. And the Dollar Tree has closed nearly 700 of poor-performing stores out of 1,000. That's almost 2/3 of their stores are being closed. And then again, the good news is, I think, is the federal judge blocked the $25 billion Kroger acquisition of Albertsons/Vons supermarkets. That combination would have created 5,000 stores. And then General Motors is ending its what they call their Cruise Robo-Taxi program, in which they invested $10 billion in 2016. So that program has been terminated. I mentioned earlier about bankruptcies reported the highest level since the pandemic in the restaurant industry. We're talking about over 55,000 fatalities. And you can see a lot of the restaurants such as Rubio's, TGI Fridays, burger places, pizza places all across the board, Red Lobster, etc. So a lot of these have filed bankruptcy. Many have already closed. Now we look at Party City. For those of you who ever used it, they closed all 700 stores about a month ago after nearly 40 years of operation. Then Southwest Airlines has changed their strategy going forward this year. In addition to that, they're going to pause corporate hiring, and most summer internships have been cut. In addition to that, some of the social programs they've had during the year are being terminated also to cut costs. And then finally, we have Walgreens is in a turnaround mode. And what they're doing now is they're going to close another 500. They've already closed 1,200 of non-performing stores. So that kind of takes you through where we are relative to the economy. So what I'd like to do now is open up for Q&A.